Welcome everyone. What made investing so attractive for me and how am I planning to reach my investment goals? Today we are going to talk about the investment strategy that I use. I am a long-term investor. I'm not here to make some quick money. I'm in the stock market to let a part of my income grow exponentially with compound interest. Does that mean I don't have to go to work? No, it's the opposite. To grow your own investment portfolio, you need to have an income. The average person in Belgium makes around 2,000 euros each month. If you save 15% of your income, you can invest 300 euros every month. Maybe this is a little bit much with all the expenses you have. So as a solution, it's important to find yourself a working girlfriend or boyfriend. That way, both of you only have to save 7.5%. I'm 21 years old now, and last week I had around 8,500 euros in my portfolio. If I save 300 euros every month till I'm 25 years old and put it into an S&P 500 ETF, this ETF has an average annual return around 12%, my money would be worth around 31,000 euros. In only 4 years I would have made 8,800 euros in return for investing in the 500 biggest American companies. That's not bad, right? I didn't even have to work for it. Imagine now, I do this for a longer time. I invest 300 euros every month till I'm 50 years old. My money would be now worth 1,050,000 euros. That's crazy, right? My assumptions are pretty realistic and reachable. The largest portion of this money is from interests. Most people don't even think about it because they assume it's not possible. With the right mindset and discipline, it is possible. If you can increase your investing skills throughout the years, you might even be able to beat the 12% yearly return, which would result in more gains. So, how am I planning to realize those 12% gains? There are three main types of stocks that you can buy in the stock market. These are value, growth, and dividend stocks. Each of these stocks have their own specialty and risk factor. A value stock is a stock with a good valuation compared to their fundamentals or to the market. A low PE ratio characterizes these stocks. Usually there is some bad sentiment or uncertainties around the company which can present a good buying opportunity. A growth stock is a stock that has a lot of growth opportunity in revenue and earnings. They are anticipated to have a higher growth rate than the average market. Usually, growth stocks tend to have low earnings or no earnings, which makes them have a higher PE and be a bit riskier. For example, when the company does not grow at the expected speed, they can tumble down in price very quickly. A dividend stock is a company that pays dividends to shareholders. This way you can have passive income as an investor. You don't have to do anything to obtain this income. Dividend stocks tend to be less risky because the companies that pay out dividends mostly have stable earnings and are around for a longer time. But you need to be careful with companies that pay out a dividend yield higher than 5 to 6%. The stock price might have fallen a lot because of a certain event, or the company pays out more than they can afford. So which of these kind of stocks am I buying and what is my strategy? I like to have a mix of them all in my portfolio. On first sight, my portfolio looks a bit heavy on growth stocks, but I still have a considerable amount of value and dividend stocks. Some of my growth stocks even pay dividends or have a very good valuation. Why is a combination of them all so important? Valuation is one of the most important things when you buy a stock. Paying a high price for a company will give you less returns in the future. If I can wait for a company to drop in price and buy it at that moment, I can have a lot higher returns in the future. Of course, it's hard to predict the market, but that is not a reason to buy overvalued companies that you like. A stock and a company are two different things and will not always follow each other in performance. I'm still young, so I have plenty of time to let my companies grow. That is why I like innovative companies like Gulika and Sofa Industries or Daqo New Energy. I think in the future they can scale their business a couple of times and there will be more demand for their products. Next to that, both of them have a pretty low valuation at the moment and Kluke and Sofa Industries even pays me some dividends to hold their company. So for me, this is a win-win scenario. Dividend stocks give me interest without having to sell any shares. Every year, it is also possible for the company to increase their dividends. If I reinvest these dividends, I will get interest on increasing interest. This results into compound interest. The longer I keep doing this, the more money I will make in the long term. As you can see, all of the three types of stocks are very important when investing and can be combined together. This was everything for today. Thanks for watching. Subscribe and smash the like button if you enjoyed the video. If you have any questions, leave them down below in the comment section or send me an email. Below the video you can find the link to Book Zero where you can get a free share when you top up your account. Take care and see you in the next video.